This video is presented to you by Third Richardson Group LLC. The U.S. stock market. Influence on macroeconomy. What is the stock market? The stock market refers to public markets that exist for issuing, buying, and selling stocks that trade on a stock exchange or over the counter. Stocks, also known as equities, represent fractional ownership in a company, and the stock market is a place where investors can buy and sell ownership of such investable assets. An efficiently functioning stock market is considered critical to economic development as it gives companies the ability to quickly access capital from the public. Purposes of the stock market: capital and investment income. The stock market serves two very important purposes. The first is to provide capital to companies that they can use to fund and expand their businesses. If a company issues 1 million shares of stock that initially sell for $10 a share, then that provides the company with $10 million of capital that it can use to grow its business, minus whatever fees the company pays for an investment bank to manage the stock offering. By offering stock shares instead of borrowing the capital needed for expansion, the company avoids incurring debt and paying interest charges on that debt. The secondary purpose the stock market serves is to give investors, those who purchase stocks, the opportunity to share in the profits of publicly traded companies. Investors can profit from stock buying in one of two ways. The other way investors can profit from buying stocks is by selling their stock for a profit if the stock price increases from their purchase price. For example, if an investor buys shares of a company's stock at $10 a share and the price of the stock subsequently rises to $15 a share, the investors can then realize a 50% profit on their investment by selling their shares. Impact of U.S. stock market on global economy. The past 2 weeks on global financial markets have been brutal. Monday was no exception, and that's in the U.S., in Asia, and in Europe. Of course, the stock market is not the economy, but in this case, stock markets are looking at the economy and not liking what they're seeing. The British pound hit a record low against the U.S. dollar. Plus, energy markets are indicating that a recession's on the way because the price of oil has been falling, which is a sign of weak demand. And everyone's dealing with the effects of Russia's war in Ukraine. The Organization for Economic Cooperation and Development said Monday that the conflict will cost the global economy $2.2 trillion in lost output. The U.S. is the world's biggest economy, with a 2021 gross domestic product, or GDP, of nearly $23 trillion. It is about 1.5 times the size of the second biggest economy, China, whose 2021 GDP was $17.7 trillion. In terms of market capitalization relative to the size of the economy, the U.S. is the world's biggest by some distance, with a 230% ratio of market capitalization relative to GDP as of the year 2021. Canada is second at 172%, and Japan's market is a distant third, with just over 128% of market cap compared to its economic output. Wall Street has such a significant impact on the global economy because it is the trading hub of the biggest financial markets in the world's richest nation. Wall Street is home to the venerable New York Stock Exchange, which is the undisputed leader worldwide in terms of average daily share trading volume and total market capitalization of its listed companies. The Nasdaq Stock Exchange, the second largest exchange globally, also has its headquarters on Wall Street. Macroeconomic indicators that affect the U.S. stock market. Gross domestic product. The most comprehensive economic indicator is gross domestic product, or GDP, which measures the value of all goods and services produced in a country during a specific time period. As such, GDP provides a basic measure of growth or contraction in an economy, making it a general gauge of economic health. Naturally, this measurement has an effect on the stock market because a stock's price generally reflects expectations of a company's future profitability. When an economy is healthy and growing, businesses are more likely to report better earnings and growth, and vice versa. Unemployment rate and jobs report. Two key measures of employment also affect stocks. One is the unemployment rate. Like GDP, the unemployment rate reflects strength or weakness in the economy. The monthly jobs report by the U.S. Bureau of Labor Statistics can show that hiring is picking up or slowing down, both of which can be useful in predicting future levels of economic activity. The Consumer Price and Produce Price Indexes. Inflation is also closely watched by investors. Both the Consumer Price Index, or CPI, and Producer Price Index, or PPI, measure price changes in a range of goods and services. These are important because of rising inflation, that is, higher prices, can hurt consumer spending, which makes up more than 2/3 of the GDP, and cause the Federal Reserve to raise interest rates to control price gains. Retail sales. A more direct measure of the health of consumers is retail sales. Any extended drop-off in retail spending could be taken as a sign of a downturn in the economy, affecting business profits and hiring. An upswing, of course, can be taken as bullish, giving investors reason to push stock prices higher. Industrial output. While not as important as it once was, industrial production is still a key indicator for the health of the economy. Released by the Federal Reserve, the Industrial Production Index, or IPI, produces a snapshot of the health of the nation's factories. The results can be volatile, so policymakers and investors look for confirmation of a downturn or upswing over multiple months. Thank you for watching this video. Make sure to visit thirdgroup.com for more information about the U.S. stock market.